This is me, Jenny. Welcome to my video presentation. Title of my video presentation is Equity Valuation, Applications and Processes. Part 1, 1.0. Introduction. Valuation. Valuation is the estimation of an asset's value based on variables perceived to be related to future investment returns, on comparisons with similar assets, or, when relevant, on estimates of immediate liquidation proceeds.
2.0 Value definitions and valuation applications. 2.1 What is value? 2.1.1 Intrinsic value. A critical assumption in equity valuation, as applied to publicly traded securities, is that the market price of a security can differ from its intrinsic value. The intrinsic value of any asset is the value of the asset given a hypothetically complete understanding of the asset's investment characteristics. For any investor, an estimate of intrinsic value reflects his or her view of the true or real value of an asset. If one assumed that the market price of an equity security perfectly reflected its intrinsic value, valuation would simply require looking at the market price. 2.1.2 Going concern value and liquidation value. A company generally has one value if it is to be immediately dissolved and another value if it will continue in operation. In estimating value, a going concern assumptions is the assumption that the company will continue its business activities into the foreseeable future. In other words, the company will continue to produce and sell its goods and services, use its assets in a value-maximizing way for a relevant economic time frame, and access its optimal sources of financing. Nevertheless, a going concern assumption may not be appropriate for a company in financial distress. An alternative to a company's going concern value is its value if we're dissolved and its assets sold individually, known as its liquidation value. For many companies, the value added by assets working together and by human capital applied to managing those assets makes estimated going concern value greater than liquidation value. Besides, the value of a company's assets would likely differ depending on the time frame available for liquidating them. 2.1.3 Fair market value and investment value. Fair market value is the price at which an asset or liability would change hands between a willing buyer and a willing seller when the former is not under any compulsion to buy and the latter is not under any compulsion to sell. Fair market value concept includes an assumption that both buyer and seller are informed of all material aspects of the underlying investment. Fair market value has often been used in valuation related to assessing taxes. Next, the concept of value to a specific buyer taking account of potential synergies and based on the investor's requirements and expectations is called investment value. Let's move on to the next learning outcomes, which is the applications of equity valuation. First is share-based payment, compensation. Second is appraising private businesses. Next is communicating with analysts and shareholders, evaluating business strategies and models. Next is rendering fairness opinions. Apart from that, there is evaluating corporate events and inferring or extracting market expectations. Lastly, selecting stocks. Let's look deep into each of these applications. First is share-based payment, compensation. Share-based payments such as restricted stock grants are sometimes part of executive compensation. Estimation of their value frequently depends on using equity valuation methods. Second is appraising private businesses. Valuation of the equity of private businesses is important for transactional purposes and tax reporting purposes, among others. The absence of a market price imparts distinctive characteristics to such valuations, although the fundamental models are shared with public equity valuation. Next is communicating with analysts and shareholders. Valuation concepts facilitate communication and discussion among company management, shareholders, and analysts on a range of corporate issues affecting company value. Besides that, evaluating business strategies and models. Companies concerned with maximizing shareholder value evaluate the effect of alternative strategies on share value. Next is rendering fairness opinions. The parties to a merger may be required to seek a fairness opinion on the terms of the merger from a third party, such as an investment bank. Valuation is central to such opinions. Apart from that, there is evaluating corporate events. Investment bankers, corporate analysts, and investment analysts use valuation tools to assess the impact of such corporate events as mergers, acquisitions, divestitures, spin-offs, and going private transactions. Each of these events affects a company's future cash flows and, thus the value of its equity. Furthermore, in mergers and acquisitions, the company's own common stock is often used as currency for the purchase. Investors then want to know whether the stock is valued. Next is inferring, extracting, market expectations. Market prices reflect the expectations of investors about the future performance of companies. To extract or reverse engineer a market expectation, the analyst selects a valuation model that relates value to expectations about fundamentals and is appropriate given the characteristics of the stock. Next, the analyst estimates values for all fundamentals in the model except the fundamental of interest. The analyst then solves for the value of the fundamental of interest that results in a model value equal to the current market price. Lastly, selecting stocks. Equity analysts continually address the same question for every common stock, that is, either a current or prospective portfolio holding, or for every stock that they are responsible for covering. Is this security fairly priced, overpriced, or underpriced relative to its current estimated intrinsic value and relative to the price of comparable securities?
3.0 The valuation process. There are 5 steps in valuation process, which are 1. Understanding the business. 2. Forecasting company performance. 3. Selecting the appropriate valuation model. 4. Converting forecasts to a valuation. 5. Applying the valuation. Conclusions. 3.1 Understanding the business. In this process, industry and competitive analysis, together with an analysis of the company's financial reports, provides a basis for forecasting performance. 3.1.1 Industry and competitive analysis. Various frameworks exist for industry and competitive analysis. Frameworks' usefulness help to ensure that an analysis gives appropriate attention to the most important economic drivers of a business. Highlight which aspects of a company's business present the greatest challenges and opportunities, and should thus be the subject of further investigation and/or more extensive sensitivity analysis. Frameworks may be useful, as analysts focus on the following questions, relevant to understanding a business. The first question is, how attractive are the industries in which the company operates in terms of offering prospects for sustained profitability? Next, what is the company's relative competitive position within its industry, and what is its competitive strategy? And lastly, how well has the company executed its strategy, and what are its prospects for future execution? The first question is, how attractive are the industries in which the company operates, in terms of offering prospects for sustained profitability? Inherent industry profitability is one important factor in determining a company's profitability. The 5 forces characterizing industry structure are summarized here with an explanation of how each could positively affect inherent industry profitability. For each force, the opposite situation would negatively affect inherent industry profitability. The first force is intra-industry rivalry. Lower rivalry among industry participants. For example, in a faster-growing industry, with relatively few competitors and/or good brand identification, it enhances inherent industry profitability. The second force is new entrants. Relatively high costs to enter an industry, or other entry barriers, such as government policies, will be resulting in fewer new participants, and less competition, thus enhancing inherent industry profitability. The third force is substitutes. When few potential substitutes exist, and/or the cost to switch to a substitute is high, industry participants are less constrained in raising prices, thus enhancing inherent industry profitability. Next is the supplier power. When many suppliers of the inputs needed by industry participants exist, suppliers have limited power to raise prices, and thus would not represent inherent downward pressure on industry profitability. The last force is buyer power. When many customers for an industry's product exist, customers have limited power to negotiate lower prices, and thus would not represent inherent downward pressure on industry profitability. The next question is, what is the company's relative competitive position within its industry, and what is its competitive strategy? Porter identifies 3 generic corporate strategies for achieving above-average performance. 1. Cost leadership, being the lowest cost producer, while offering products comparable to those of other companies, so that products can be priced at, or near the industry average. 2. Differentiation, offering unique products or services, along some dimensions that are widely valued by buyers so that the company can command premium prices. 3. Focus, seeking a competitive advantage within a target segment, or segments of the industry, based on either cost leadership, cost focus, or differentiation, differentiation focus. The last question is, how well has the company executed its strategy, and what are its prospects for future execution? In examining financial and operational strategic execution, 2 caveats merit mention. First, the importance of qualitative, that is, non-numeric factors must be considered. Second, it is important to avoid simply extrapolating past operating results when forecasting future performance. In general, economic and technological forces can often contribute to the phenomenon of regression toward the mean. 1.2. Analysis of financial reports. The aspects of a financial report that are most relevant for evaluating a company's success in implementing strategic choices vary across companies and industries. For established companies, financial ratio analysis is useful. Individual drivers of profitability, for merchandising and manufacturing companies, can be evaluated against the company's stated strategic objectives. 3.1.3 Sources of information. An important perspective on industry and competition is sometimes provided by companies themselves in regulator-mandated disclosures, regulatory filings, company press releases, investor relations materials, and contacts with analysts. Analysts can compare the information provided directly by companies to their own independent research. 3.1.4 Considerations in using accounting information. In evaluating a company's historical performance and developing forecasts of future performance, analysts typically rely heavily on companies' accounting information and financial disclosure. The term quality of earnings analysis broadly includes the scrutiny of all financial statements, including the balance sheet, to evaluate both the sustainability of a company's performance and how accurately the reported information reflects economic reality. That's all from our group for the topic of equity valuation, application and processes Part 1. Thank you.